Hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Today I've got a couple of thoughts floating around in my head that I want to talk about. I want to frame for us what a soft landing might look like. We do have one example that we can use. So we'll run through a few of the charts we've been looking at recently through the lens of what a soft landing might look like. Some of the eager bulls out there might not like the amount of time I say it will take before we get clarity, but we'll save all that for deeper into the video. Don't go anywhere. We have much to discuss today. If you enjoy my content and you'd like to see more, please give this video a thumbs up and subscribe to my channel and share it with your friends. Your support means a lot to me, and I thank you for it. And if you're new to the channel, if this is your first time watching me, I highly recommend you consider going into the description and opening my Recession Roundup playlist series and watching the videos before today so that you can catch up on the study that we've been doing on economic downturns. There's some work in there I'm very proud of, some really cool, unique perspectives on the data and charts you won't see anywhere. So go check it out and share it with people. I would like to get the word out. But we have much to discuss today, so enough of me plugging this channel. You're already here, let's get into it. So we'll start here today with our chart from last week, showing the fractal of non-farm payrolls from all prior recessions going back about 70 years versus today here in the black line. We can see we're following it pretty closely. And this was kind of the focus of our video last week, where we were trying to frame for ourselves how much time we've got here in this realistic, what I was calling the window of danger, before we could start to feel more comfortable that we've exited the sweet spot, replete with historical references of downturns. We need to get past this window of time here where recessions begin, which are marked down here at the bottom. We need to get past this point and see things like non-farm payrolls not perform this historical fractal where it rises and then contracts and you see people losing their jobs. That's what this is on the backside. We need to see it continue to expand, as well as many of the other things we talked about last week: industrial production, real income, manufacturing sales, retail sales, everything that's kind of underperforming right now. The weaker parts of the economy that we've been studying for the last couple of weeks that lead us into a recession. If you have question marks about what we're talking about right now, I highly suggest you go into the description, click on the link to view my Recession series playlist, and watch those videos. They'll catch you all up to what we're looking at. So as I was thinking about this over the last few days, I wanted to see if we could frame for ourselves what a soft landing might look like in the context of this data, in the way that we are looking at it. And we do have one example that we can pull from, and it's 1966. So this is the same chart of this one here that we've been looking at in many different ways. But I've added another line. It's the red line. You can see it kind of squishes our fractal down. And this is 1966. So 1966 was a soft landing. We didn't have a recession, an official recession, but we did have some sluggishness in the economy. The stock market fell, but we didn't have a blowout in unemployment, and we didn't have the other markers that the NBER considered to be a recession. And here's what our soft landing looked like on the price chart. It was right here in 1966 before we entered the really choppy stagflationary period of the 70s. And in 1966, there was a lot going on. So Lyndon B. Johnson was president. Kennedy had already been assassinated. We were in the middle of the Vietnam War. The government was needing to finance the war, so they were issuing a ton of new debt onto the market, just massive bill issuance, far outstripping what they had done before. And at the same time, there was pressure on the banks through something called Regulation Q, which limited the deposit rates that they offered customers and some other controls. And just generally, there was a lot of pressure on the financial system and on the economy broadly to support government war spending without just falling into an abyss. We did have a drawdown on the stock market, and I think it was about 20%, 23.5%. So it was an official bear market, but we didn't have a recession. However, there were some other signs in the economy that we were possibly going to slip into a recession. The yield curve briefly inverted. It's maybe the only time we have history of where it inverted and we didn't get the bona fide recession. But we saw some other things weaken. Things like real retail sales came down heavily and some other pieces of the cyclical part of the economy. So let's go back to our chart. right? Again, this is the same chart as this one over here. We've just added 1966. And what you'll notice in the normal fractal, right, we have growth in non-farm payrolls after the yield curve inverts. And then after about 10, 13, 15 months, that's around the period of time where history shows employment starts softening. We see it roll over. People begin losing their jobs. But if we go to the 1966 fractal, that period of time where non-farm payrolls began to weaken is completely ignored. By 1966, employment just continued to rise the entire time. But let's move it forward to the cyclical parts of the economy, the things that are weak now that we're looking at to show a bit of signal and lead us into this process. Well, in 1966, industrial production did contract for a few months, but then it just shot back up and began expanding, about 11 or 12 months after the yield curve flashed an inversion. Moving on to the other pieces, real manufacturing sales, we can see here again showed a lot of strength. Doesn't really look like today or the recessionary fractal continued to expand after a brief little hiccup a couple of months after the yield curve inverted. Now, real retail sales did dip pretty heavily in 1966. You can see that here. And so if we were to just see weakness today in real retail sales and we weren't really seeing much else confluent, we could say maybe this is 1966. Maybe it's going to look the same. But you can tell here, even in 1966, they experienced about a year and a half of drawdown on real retail sales before it was able to break back above the zero line and resume expanding. Real consumption, again, just kind of went straight up the whole time, didn't really have that softening where the growth rate slowed down and it went a little sideways into the recession like we've seen on real consumption in the past. And real incomes, again, a lot of strength. So we have an example here that we can use. We don't have to look like 1966 to have a soft landing, to avoid having high unemployment, to avoid what the NBER would call a recession. But we also can see that it's a bit of a mixed bag. Some things looked very weak, some things looked very strong. And it wasn't until about a year after the yield curve inverted that you really started to see that the expansion was continuing in 1966, before you really knew that we weren't going to dip into a recession like all of the other historical fractals since then have shown us. So my takeaway from looking at it through this lens, from adding in 1966 to what we were looking at before, is that I think we still have another half of a year before we can start to think maybe we're printing a soft landing fractal. And maybe instead, if we see the 3-month 10-year yield curve re-steepen out of inversion, if we see things like employment continue to expand and not bow over like they have in the past in other periods of recession, if it looks a little more like 1966, then maybe we can start to think this time is different. This time is pretty unique, even though we've got all these check boxes ticked off, including the PMIs being below 47, like we've talked about before. Despite all of that, we ended up with a soft landing. Well, I'd love to see that outcome, and maybe we will get it. It has to be considered as a possibility, though everything we've talked about suggests to me it can't be the base case, and in fact, it should be a pretty low possibility chance in the distribution of outcomes. I would probably give this 10% or less as a likelihood. And based on historical distributions, that's accurate. 10%, maybe less, that seems about reasonable. So it's not impossible that we avoid recession, but the odds are certainly stacked against us achieving that outcome. But the real takeaway, the learning from this perspective, is that we won't know that for several more months, because the strength that we see in some of these indicators is not what we're seeing today. I mean, look at real incomes. We are below, as we explored before, real incomes are below the entire historical series. All prior comparisons, real income is below. And here is where 1966 was. It was kind of in the middle of the pack, and then it just broke away as everything else went sideways. So this is the kind of thing we'd want to see if we're going to call this a soft landing. But right now where we are, in the current fractal, we're pretty weak. We're down near the bottom of the distribution for a lot of these metrics, which is what we talked about last week. So we would really want to see these hold up, maintain some of their integrity, not just completely dissolve. We'd like to see employment continue to stay strong. As we see right now, it's one of the strongest employment growth periods we've ever had in relation to the yield curve inversion. So if that stays strong, and then some of these other things begin to show a little more strength, a little more virility, and grow back into expansion, then maybe half a year from now, we can start talking about soft landing. But when you look out across the Twitter landscape, when you look at FinTwit, when you look at all the macro podcasts on YouTube and Spotify, people aren't looking at it through this lens. People are taking things very literally. They're going print by print every week, every month, and trying to glean new insights from the latest initial claims data or whatever. And I'm not trying to say you can't find insights there. You certainly could, and I've done plenty of research in those regards. But folks aren't taking a big enough perspective here and really looking at how long these processes take to play out, right? We are still in the first third of the baseball game, which is the analogy we used during the Recession series when I said that I felt like we were in maybe the fourth inning of a 9-inning baseball game. And when you put it on this chart here, it really reinforces that concept. So we've got some more time. We've got another half a year. It won't be until Q4 of this year or Q1 of next year when we've learned a lot more about the economy and we see much more data prints that we can start to say maybe this is a soft landing, maybe it's not. And we'll continue to come back to this point throughout this year as we look at new data, as we come back to this chart and look at things in other perspectives. I want to keep reminding myself, because it helps me keep perspective, and remind you guys, as long as it is valid and the data supports it, that we should maintain patience and keep a zoomed out perspective, because there is much more left to play out before we know how this saga concludes. Now, I know people are really excited about the stock market, which was mostly up the last couple of months, though it has been softening recently. And a point I emphasized in the video last week that I cannot make more strongly than this: there is not a single price on the S&P 500 that will tell you anything about recession risk. So stop looking at the stock market to tell you whether the economy is doing okay. It will not tell you. Now, today we did get a new job number. It was the ADP Employment Change number. And now that is not government data, but it's one of the sister reports that goes with the jobs report. And it was an absolute blowout. 500,000 jobs were added when the forecast was for less than half of that. I suspect there is some weirdness going on with the seasonal adjustments on this metric. I find it very hard to believe that that's a real number. I think it's much more likely that there are some base effects playing into this, something over the last couple of years in the calculations that's affecting what it thinks the actual growth in employment is, because they didn't actually count 497,000 individual Americans getting jobs. But alas, it is a very large number, and as I look out across Twitter this morning, a lot of the bullish people that I follow are pointing at it and saying, look, the doomers were wrong, the naysayers were wrong, you said the end was nigh, clearly you are wrong. But again, I just keep coming back to this chart here, and I will keep coming back to this chart until this black line just shoots way up above it and it starts looking like this one. So yes, very large ADP number. And in fact, when you look at it, it blew out all of 2022. Pretty impressive. But I think there's definitely some funniness going on in there. It might have something to do with the seasonal adjustments. They have a look back period, and there's some assumptions built into the calculation based on the past. So I think there's some weirdness there. Probably not a real number, but it's a big number. And it reinforces for people that the economy is doing just fine. And we know that it should be doing just fine. Labor will be strong until it just isn't anymore. And if you've been following me the last few weeks, you know what I'm saying. That doesn't mean that it's imminently about to collapse. That doesn't mean that next month the jobs report will be 500,000 negative. It could be just death of 1,000 cuts over a series of months. Everyone's looking for a black swan surprise to drive us down into a lower pit of hell. Maybe that happens. There's no way to predict that. But we don't have to have that for the outcomes that I suspect are likely to play out. My thesis is not contingent upon a black swan happening, because I think there's enough embedded tightness and sluggishness into the economy, encouraged by the hawkish monetary policy over the last year and a half, that we will experience a slowdown, and it will manifest in ways that people are probably not expecting. That's what I think will happen. And it probably takes course over many months, and not something we just wake up one day and everything went to shit. And we can look at jobless claims. And I think jobless claims are an interesting place to look. It's where everybody's focused right now. So what did I do? I made a chart of initial claims data and where it is at the beginning of all prior recessions as a percentage of the labor force. So the total amount of people, both initial claims and continuing claims, those are people who filed for unemployment already and are continuing that process or making another request for payment. So if you combine initial and continuing claims together into total claims. And then you look at it as a percent of the total labor force, which includes those working and those not working but seeking work. You put them all together, claims as a percent. Here's those numbers. What you'll notice is 2% is a pretty good threshold, right? We got 1.9, 2.1, some 3s, 2.2, 2.1, 2.1. So pretty consistently, total claims are around 2% of the labor force at the beginning of recessions. At least the last 1, 2, 3, 4, 5, 6, 7 recessions. If we look at COVID, it was 1.3, but I think we can all remember that COVID was artificially driven. We literally shut the economy down. Everything happened at light speed. There were some signals that we were due for a recession in 2020. The bond market was saying so. Other parts of the economy were saying so. We had an inverted yield curve in 2019. There were some signs that we were due for that. But then when COVID hit, it kind of broke all the charts. It broke everyone's timelines, and we know what happened. But let's just put this number aside and let's just look at all these others. 2% seems like a solid threshold for where recessions usually begin. So where are we today? We're at 1.2%. So we're down here below the COVID threshold. We are not yet at anywhere near these values up here. But what if we look at it in rate of change terms? What if we don't look at it just as a percent of the whole? What if we see the rate of change of initial claims off their low? That's this chart here. So up at the top, we have initial claims as a percentage rise off of its 2-year low. And I chose 2 years because it's a good buffer window between recessions, and initial claims tend to go down, 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 down till they set a floor, and then they rise quickly. So if we can establish where the floor is, we can get a general idea of the rise in claims. Now, in the middle here is that same kind of dot chart that we've been doing. What is the value at the beginning of the recession? So in this case, it is what is the percentage rise, the rate of change of initial claims on a 4-week moving average at the beginning of every recession. And what you see here, they're pretty high, 15 to 25% rise in initial claims, 46% in 2000. But many of these others, look, 23, 15, 30, 14, 27, 21%, 5.5% in COVID. But where are we today? Well, we're at 31, almost 32%. So we're currently above all of these values except for the year 2000. Now down here at the bottom, these blue bars are simply showing when the rate of change of initial claims is 20% off of its low. When it has risen at least 20%, that's when you get these blue bars. And what you'll see if you compare these blue bars to the gray recession bars right above them, they align pretty closely. They go deeper past the recession point, and there are very few false positives. There's a couple of little glitches like here or there outside of recessions, but for the most part, it takes place during a recession because job loss is the recession. Those things go hand in hand. But right now, today, initial claims up considerably off its low, up over 30% off its low. And we've seen in the past, that's a dangerous threshold. So we're getting really close to a period of time where labor weakness is flying in the face of the kinds of prints that we're getting on a monthly and weekly basis. The rate of change of the market itself, the things going on under the hood, are screaming at us that we're getting really close to a danger point. So people are confused. They're looking in the wrong places. They're looking at claims up off the lows, but still relatively muted compared to history. And confusingly, are only at 1.2% of the total labor force, right? Which is not a threshold that we normally see at the start of recessions. However, the rate of change is a level that we normally see at the start of recessions. And in fact, it's the rate of change we've seen at the start of every recession, except for 2000, going back to 1970. So this is slightly conflicting data in the sense that we've got strong labor prints, but at the same time, we're seeing rate of change metrics in unemployment that suggest weakness. And those two things can happen at the same time, right? There can be labor demand while there are also people in other sectors who are losing their jobs, right? This happens unevenly. So I've got my eye on this, and it's something I want us to pay attention to on the channel here over the next few weeks and watch the initial claims data and see if it starts to corroborate labor weakness, maybe moving forward in time a little bit more than what this chart suggests. Maybe we won't get to month 13 or 14. Maybe it starts back here. Can't say yet. And while we're on the subject of labor, something I want to touch on is the strength of wage growth. So I think it's been pretty obvious that the labor market's been really strong. We've had really high non-farm payroll numbers, kind of month over month. It's consistently beating forecasts. Part of that might be seasonal adjustment factors, but nonetheless, there is a lot of demand for labor. There's a lot of demand for workers. In fact, there is more demand for workers in a full strength economy than we actually have to supply those businesses with today. We don't have enough workers, and that's driving wage growth, and that's making it to where businesses are more reluctant to let go of the talent that they have because they're not sure if they'll be able to easily replace them. People seem to be leaving the labor force and just not coming back. Some of that is demographic driven, but we'll talk about that at a different time. What I want to focus on here briefly is wage growth. So we are in a society of consumption. GDP in the US is like 68% consumption, and everyone's spending is someone else's income. So when you have high consumption, you have somebody else making money off of that. And largely, going back through history, prices and wages are intrinsically linked. If you have businesses who are seeing increased demand for their products, they raise prices. People who are then paying higher prices begin expecting higher wages from their businesses. Those businesses, feeling that pressure, give people raises, and in order to supplant those higher labor costs, they have to raise prices. And it creates a feedback loop. If it gets out of control, they call it the wage price spiral, and that was something that was really concerning in the 70s. I don't think that's exactly what we have today, but we've got a minor version of the same force, and that is because wages and prices go together. Let me show you that on a different chart real quick before we talk about the one I was just showing. Here are wages and prices. This is CPI versus average hourly earnings going all the way back to the 30s, right? CPI is in black, wages are in red. And you can see it's plain as day. The year-over-year rate of change follow each other very closely for these two metrics. They're not one-to-one exact. There's a bit of delay. There's some dispersion in the economy itself. It's not going to make them one-to-one. But largely speaking, high spikes in prices require high spikes in income to sustain them. That's just how it works. If you have a lot of money printing helping to spur that spending and spur that growth, everybody's wages goes up. All the prices go up and they stay there. So I wanted to show this view to give you the long-term perspective that when people talk about wage growth being too high or not being consistent with the Fed's inflation mandate, this is what they're talking about. So right now we've got CPI at 4%, but we have wage growth year over year still hanging around 5%, almost any which way that you slice it. So when you have an economy that doesn't have enough workers for the amount of full service demand that they've got, and they're continually having to raise people's wages by 4.5%, 5.5% over the prior year, that necessitates higher prices, and it makes it very difficult for a Federal Reserve that's trying to bring inflation down to really see a lot of progress unless they're willing to create more unemployment. And they just so far have not been able to manifest that, which is why I think it's really important that we watch initial claims and keep an eye on just the general heat of the labor market in as many ways as we can. Because until we see weakness there really starting to come to the forefront, then we will continue to see strong wage growth and likely relatively stubborn inflation, particularly core inflation, which is heavily wage influenced. So I brought up that wage chart because I wanted to show you this wage chart. I told you that wages are growing at about a 5% clip year over year. So let's look at it. Let's look at it in 4 different ways. We've got wages year over year. This is the way that the media usually reports on everything. They take what this month's value is and they compare it to this same month last year, and that's the year over year change. It's a very slow way of looking at the metric, but it's the most common. If you look at it year over year, wages are at 5%. Okay, let's do it on a 6-month basis. Let's look at it now versus 6 months ago, and let's annualize that rate, meaning basically double it. Let's assume that same growth over a whole year. What is that number? It's 4.8%. So on a 6-month basis, wages are growing at 4.8%. What about an even shorter term basis? What about a 3-month basis? 4.9%. So over the last quarter, if we annualized the rate of growth, it's at 4.9%. What if we annualize the rate of growth just from the last month? We're at 5.6%. So we've got wages growing on a 1-month, 3-month, 6-month, and year-over-year basis, and all of them are at 5%. And we've got a Fed targeting 2% inflation. And I already showed you you that wages and prices go closely together. So if we have wage growth stabilizing, it's not that it has spiked to 5%. Look at this. It is stable. This is all the way back to March of last year. For the last calendar year, wage growth has barely come down a single percentage point. So I think that this is going to make it very unlikely for the Fed to get a clear signal to cut interest rates anytime soon, unless we see a major chop in growth expectations. But barring that, we have a hot labor market. There's more demand than there is supply. It's what Powell has been saying since last year. We were talking about this in May of 2022 when he was giving interviews talking about how there's way too much demand, and that's what they're going to try to target. They haven't been able to do that yet. Their attempts to slow walk this economy and this particular strategy that Powell has used with rate hikes are simply not working quickly enough for them to see results yet. And what I have concerns about is that they will see things like this stubborn wage growth. They will see that as a green light to continue raising interest rates, which is not going to attack demand the way they think it is. Not the way it worked in the 1970s, certainly. And that what that will lead us to is the economy hitting a concrete wall. That's what I'm worried about. And I think as we've been studying the cyclical nature of downturns and how they roll from one part of the economy to the other, and I think about the lagging nature of labor, how it's always the last thing to go, how that is what the Fed is targeting, and how that part of the economy is the place where inflation has stabilized the most at 4.5% to 5%, which is more than double the inflation target. So I think we are stuck on higher for longer island for quite a while more than this. I don't think that we can go years and years with higher interest rates. There will be a point when the cold reality of math cannot be avoided, and the U.S. government must monetize its debts or lower rates. There will be no other alternative. But that doesn't mean that in the interim, we can't see some really ugly dynamics playing against each other. So I remain very cautious. I see a big shitstorm brewing that we have not climbed out of, despite what the NASDAQ and the S&P may be showing you, despite what Bitcoin may be showing some of you. I view all of those moves as a dislocation, a bear market rally, a very intense one. And a bear market rally doesn't mean that it has to stop well below the all-time high. We could threaten the all-time high for all I know. We could make a new one. But if we continue to see data deteriorating under the surface, there is an unavoidable scenario that we will be marching towards, and history is pretty clear about what that outcome is. So keep your heads on straight, continue to watch the data, but let's keep a zoomed out perspective. Let's not get really emotional about it. Let's just watch this thing unfold. Let's continue to reference back to history and the fractals of time and the cyclical nature of the economy. We know things happen in a certain order, a relatively consistent order. We know there are pieces of the economy that soften before others. And the places where everyone looks are the last place to provide any real signal. So you're going to have a tough time out there if you're trying to relay some of these thoughts to the more low information bulls out there in the market. They don't want to hear it. We'll just talk amongst ourselves and watch the data. And maybe by the end of this year, we'll have a lot more clarity. We'll just have to see. So that's really what's on my mind today. No massive takeaway, but I've been thinking about the 1966 soft landing, and I wanted to compare it to today. I wanted to give myself some kind of a mental framing, a timeline or something, some kind of example that I can say, look, we need X more months or weeks before we can get any kind of clarity on this topic. And I think that it will take at least through the end of this year, possibly through Q1 of next year, before we get enough data to compare to our historical charts and be able to say that this is a soft landing or not. So I will rely on the data, and I will not subscribe to any of the narratives on Twitter. Make sure you follow me on Twitter right here at TXMC Trades. I have not joined Threads yet. I'm not on Instagram. I'm not on any other social media. This is my only account. I don't have a private Discord. I don't have a Telegram. If you're ever contacted by someone pretending to be me talking about those things, they are a scammer, and you should block them. If you have any questions for me, any feedback for the channel, leave them in the comments and I'll check them out. And I'll let you guys go today. Hope you had a great July 4th. I shot off a ton of fireworks with my kid, and we had a bunch of neighbors complain, so you know we did it the right way. And that's where we'll leave it today. So until next time, take care of yourselves, friends. Take care of each other. I appreciate your support and your engagement, and we will chat again in just a few days. Cheers, everyone.